What is infinite banking? I had the same question, and what I found out is it's not a product, it's a concept. It's definitely not an investment. And it allows you to take advantage of what Einstein called the eighth wonder of the world, compounding interest. He who understands it earns it, and he who doesn't pays it. And if you think using cash gets you around that rule, then it actually doesn't, because whenever you use cash, you give up the opportunity to earn interest. How do you start infinite banking? Well, you can actually start right now because, like we said, it's a concept and not a product. But there are some vehicles that are better to use for infinite banking, and we're going to get to those a little bit later, as well as some of the criticisms for the concept and the vehicles that are commonly suggested to use. But before we do that, let's look into the process to get some context. So let's paint a picture. Let's imagine a guy named John, and John, just like most people in the world, gets paid via either a job, his investments, business, whatever it is, either bi-weekly or monthly, right? This is John's money. This is fake money, by the way. I just ordered it off Amazon. But he gets paid this money, and whenever he gets it, he can do a few different things with it. The first thing he does is he puts this money into his bank account. After he puts it into his bank account, then he can either spend it, he can invest it, he can give it away, he can do whatever he wants with it, right? Now, in this scenario, the bank actually makes a ton of money off of your money. And I got really curious a little over a year ago about how banks work, and you've probably heard of fractional reserve banking. Off of this $100, in 3 years, they could easily double it. And that's a whole other video because there's some math involved. The bank makes a lot of money off of your money. With infinite banking, we change one thing about what you do with the flow of your money. Before you earn it, it goes into your bank account, and then you spend it, invest it, whatever the case. The only step you're going to add is you're going to put it into your family bank. Now, your family bank is going to earn dividends. It's going to be guaranteed growth for life. It's private. You're going to control it, unlike a regular bank. That growth that's guaranteed for life is going to be tax-free growth. That this family bank gives you leverage, is protected from creditors and debt. It transfers to the beneficiaries tax-free whenever you die. It's completely protected against market volatility, so you will experience no loss ever. And it gives you opportunities for investments, purchases, expenses, stuff like that. I know it sounds too good to be true, but hear me out for a second. It's like a mortgage, right? Every month you pay your monthly mortgage payment. A portion of that goes toward interest, a portion of that goes toward principal. Let's say you have a $300,000 house, and over time you've paid to where you have $100,000 worth of equity in that house. Now you can take out a home equity line of credit or a HELOC and use that money for whatever you want, right? Obviously you have to pay it back. Now let's say the value of your house goes up 10%. Just because you took $100,000 in equity out does not mean that you get less appreciation. It's still going to be 10% of $300,000. It's uninterrupted. That's like how your family bank is too, but with certain other advantages. What that means is, let's say this is $10,000, but sitting in my family bank. Let's say I want to take out $8,000 here, right? And let's say this is earning 6% a year. In a normal savings account, which is not going to even pay you near that much, or let's say you have this in like investments in like stocks or something. If you take out 8,000 from 10,000, that means that you're earning your 6% on 2,000 now. But with your family bank, it's just like your mortgage. You take out 8,000, you use it however you want, but you're still earning 6% on $10,000 right here. It's uninterrupted compound interest. That's the true power of your family bank. What you're doing in this case is you're taking a loan against your money so that your money can continue to earn that uninterrupted compound interest. Now, of course, there's going to be a tiny percent that you're going to pay on the loan. Let's do some math real quick. Let's say that you're earning 6%, you take out a loan at 4%. Simple math would say you're earning a 2% spread, but because you're earning 6% on an increasing balance and you're paying 4% on a decreasing balance because you do want to pay it back, that's how the infinite banking concept works, is you treat your bank like a regular bank. You're paying 4% on a decreasing amount, earning 6% on an increasing amount, so your net return is actually going to be higher than 2%. Now, what vehicle is the best to do the infinite banking concept with? A lot of you may already know, but it is a whole life policy, a specially designed whole life policy. And whenever I first heard this, my mind immediately went to 100% skepticism. Specifically designed whole life policy with a mutually owned company. Has to be a mutually owned company. They have to have a solid history of paying dividends every single year that they've ever been in existence, and they've had to be in existence for over 100 years. So what you're going to do is you're going to put money into your whole life policy, just like the mortgage example that we did earlier. A portion of that goes to what's called the cash value. Now, there's a lot of misconceptions around how whole life policies work. It varies by the product, how the agent designs it that's helping you design it, the company that is designing it with you. Like for example, a lot of people think that you can't get access to your cash value for years. Now, if it's not designed, that's true, but you can actually get access to 90% of your cash value almost immediately. But what you do is you put the money in to your whole life policy, into your family bank, and that's going to go to what's called a cash value, and you're going to earn dividends on that cash value. Then you can use that money to pay your expenses, your investments, whatever you would normally use that money for anyway, you can use it for. Now, the goal with infinite banking is to not get rich quick. It's a long-term strategy, and remember, it's not an investment. Anybody who is comparing this to an investment and saying it doesn't make sense, yeah, it doesn't make sense as an investment because it's not one. If I compared my Chase checking account to investing in real estate, that would be a stupid comparison. We're using this as a bank. You'll simply pass your money through your family bank now, and then use it for whatever your business, your investments, whatever it is, and then that will go toward the cash value, which will allow you to earn even more uninterrupted compound interest in the form of dividends, and allow you to take advantage of the what Einstein called the eighth wonder of the world, compound interest, which is an extremely powerful concept. You guys may have heard the question, would you rather have $1 million right now or have a penny that doubles every day for 30 days? And if you've heard it, then you obviously know that the penny in 30 days is going to be way more than that $1 million. That's the power of uninterrupted compound interest. If you continue to use your family bank the way that it's supposed to, that's what can happen as time goes on. We're about to look at some numbers, but one more thing before we do. Now, you can use your family bank however you want, but if you really want to take advantage of this, what you'll do is you will finance your purchases, if possible, through your family bank instead of through a financing company. For example, the numbers that we're about to look at is going to show the difference between if we finance a vehicle purchase through the bank, through a regular bank, and then if we finance it through our family bank. What you do is you give yourself the exact same terms, right? Because you don't want to steal from your bank. You want to give it back, obviously, but you don't want to just give back the money with no interest because it's your bank. The money is made through the interest, and you'll see here in a second what that means. Let's go ahead and jump into a bunch of numbers. Okay, we're going to look at a $30,000 car purchase and the difference between financing that car through a regular bank and through your family bank that you started. It's a $30,000 car purchase. Let's say you put $6,000 down and you're going to finance $24,000 at 8%. The total that you've paid is the $6,000 cash, no interest on that. You financed $24,000 at an 8% interest based off of a handy little website. I found out that equals $6,297 in interest. Total, you've paid $36,297.44 to the regular bank. Now let's take a look at your bank and what those numbers look like. Still, $30,000 car. You're going to take $30,000 from your family bank. $6,000 of that is considered down. We're not going to pay any interest on that in this example. You could, but we're not going to, just to keep it a fair fight here. $24,000 is going to be financed at 8%. We're going to pay the exact same payments to our family bank that we would have paid to the regular bank. The total that we've paid in is the same over on the regular bank. But the difference is, one, it's paid to you. That $6,297 in interest is paid to you. And also, you've earned uninterrupted compounding interest this entire time. By the way, this is on a 6-year loan. On 7 years, it would be more. I think that's the typical car loan. But you see the difference here. We haven't just paid in $36,297. We have an extra almost $12,000 over here in our bank. How did I get the $48,000 number? I'm going to show you in this breakdown here. And this is assuming a 5.5% dividend from that mutually owned insurance company to us that we have our family bank with every year. We're earning 5.5% every year on our money. And that's a pretty fair expectation based off of the historic dividend rates of the companies that we use anyway. Start of year 1, we have the $30,000. Start of year 2, we have $31,650. We just took 5.5% of $30,000. Now, every year, remember, we're taking advantage of uninterrupted compound interest. Next year, we have $33,990. And then you can see year 4, 5, and 6. At the start of year 6, we have $39,206. Now, our loan term would end at the end of year 6. At the end of year 6, because this year is whenever we've pretty much paid off of our loan at this point, and that almost all the money that we're putting into the policy this year, into our family bank this year, is going to be that extra interest that we're paying ourselves. That's why you see such a big jump from beginning of year 6 to end of year 6, start of year 7. because we got all that interest paid, that's a little over $6,000 of interest. Then we earned 5.5% on top of all of that. Now the loan does have a small interest rate. It's usually like 3 to 4%, just depends on the company, the logistics and everything. But even with that, we're gonna pay an interest about $3,000, $3,500 total throughout this loan. Even if you take off $3,000, that's still $45,000 compared to the $36,000 that we would have just given to the other bank. And now every year for the rest of your life, you're gonna be earning uninterrupted compounding interest on all that money that you just put into your family bank. You can see where this is going, and if you could finance, you could purchase a car, you could use it for education, you'd use it for a down payment on a house, or even for your house if home prices don't keep quadrupling every year. But there are some objections that people have, some concerns and some misconceptions that people have with the infinite banking and the whole life policy. I tried to cover them all here. Actually, a lot of these I had at the beginning, some of them for a long time until I really started to understand. Don't take my word for it. You can go listen to them, to other people say what they don't like about this, but I'm just gonna cover what I learned whenever I was first doing all of this research, and then what I've learned by seeing the policies, doing them, and seeing the numbers and how they play out. The first big misconception is that it takes years to build the cash value, which again, not all whole life policies are made the same. Yeah, if it's designed wrong, if you get it through like State Farm or something, then yeah, it can take years to build cash value to be able to access your cash. I gave the criteria earlier. It has to be a mutually owned company that you can get the dividends. It has to be designed a certain way. That company has to have a history of giving dividends. You can design your policies to have access to 90% of your cash value almost immediately. That one is just a big misunderstanding. Maybe somebody got a whole life policy from like State Farm or something, and they've seen that they don't have any cash value for a few years. They assume that all are like that. There's two things in a whole life policy. One is called the base and the other is the paid up additions rider. An agent gets paid the most commission on the base. If your agent just puts all the money into the base, then a lot of that money is going toward their commission. Yeah, it would take longer for you to build cash value. You have to design them a certain way that you have more cash value sooner, and it builds quicker. Now, another one that I don't understand why people say this one, but they argue that it's a bad investment. And it is bad as an investment, right? If I'm comparing my Chase banking account to investing in real estate, then why am I putting my money in my Chase banking account? Why not just put it in real estate? People who say this don't understand that we're using infinite banking as a banking system, not as an investing system. We use it as a banking system that we earn uninterrupted compound interest in the form of the dividends forever, right? And then whenever we die, we can transfer money to our beneficiaries, whether it be my kids, whether it be my wife, tax-free. You compare putting your money into a Chase bank account where you earn 0.01%, or putting it into your own bank account where you earn 5.5% every year. And then in the Chase account, when you take money out, you're not earning interest on that money anymore. But in your account, when you take money out, you're still earning interest. I think it's pretty clear cut which one is the better option. Now, another big one, which I don't understand why people are like get hung up on this one. I've heard Dave Ramsey say this. I've tried to find everybody who has criticism of infinite banking because I wanted to make sure myself whenever I was first looking into this that I wasn't being duped. But another one is you lose your cash value when you die. That one doesn't make any sense to me because let's say you have $500,000 in cash value and let's say your death benefit is $1 million and then you die. Technically your cash value is not part of the death benefit, but you have $1 million death benefit that goes out. Even if it's less, even if it's 750 grand, you lose $500,000 cash value, but then you get $750,000 in death benefit. I don't understand why that's a bad thing. That makes sense. I just don't get it. Because in this case, 500,000 million, you lose the 500,000, you get the million, you're still up 500,000. For some reason, people think that's a horrible thing. I don't get it. Another big misconception is on the dividends. Some people think you have to pay tax on those, which you don't, because those dividends are considered a return on premium, which is another thing that people say is a bad thing about this, is that it's not even a return on premium because they overcharged you. I just say, give me the money. If there's money there and they want to give it to me, I don't care what they call it. But that classification of return on premium is one of the reasons why it's not taxable, because you don't get taxed on your refunds. Maybe what things are called you know, kind of mess with people, make them upset. Now, the last two, I really didn't understand for a little while. And the first one of these two is you could lose all of your money if you miss a payment. And this one really worried me for a while until I started seeing this in action from other people and looking more into it. Let's say we have $100,000 in cash value, and let's say I can borrow up to $90,000. And if at this point you have more because you've been earning the interest. One is the dividends can pay your premium. At a certain point, your whole life policy could be to where you don't even have to pay the premium anymore because you can pay it with a dividend. But another thing is, let's say for some reason I just couldn't pay it. I would just borrow as much as I can out for the policy lapse, which I could use that money to pay the premium. But let's say I didn't want to do that for whatever reason. I just take the money out, policy lapses, and I have almost all my money, probably more than what I've put in, at least equal to what I put in, depending on if you do this, you're probably not going to let it lapse in the first 2 or 3 years. And by then, your money's grown a good bit. You don't have to pay that loan back. Regardless of what anybody says, you don't have to pay that loan back. The last one that I hear a lot is giving a company your money just to borrow your own money against your own money at 3 to 4% doesn't make sense. In that case, you would just have to look at the math. You put money into your family bank and then you borrow against it. Let's go on the high end. Let's say you're paying 4% on what you borrowed, but you're earning 6%, which is pretty standard. That's a 2% difference. Plus, like we talked about earlier, you're getting 6% on an increasing balance, but you're paying 4% on a decreasing balance. As you pay it back, your spread would actually be more than 2%. So the people that have these objections, they just don't fully understand how, one, infinite banking works. They don't understand what it is. They don't understand that there are different whole life policies that can be designed different ways with different companies that can do different things. You can go listen to the criticisms people have and do your research and determine if this is what you believe or not. That's what I did. And I like to form my own opinion and look at what I did is I looked at other people's policies that had been doing it for a little bit and their numbers to see what in reality it was. If you're interested in learning more on how this could work for you, if you're interested in just learning if it would be right for you, then I'm going to leave a link down in the description to where you can book a call with me and I'll personally hop on and we can just talk about it. You can ask some questions and you don't have to do anything, of course, but if you do want to, I'd be more than happy to help you. But if you just want to book a call to get some info, then that's totally cool too. I'm going to leave a link down in the description. And if you want to learn more about just money, wealth building, business, go ahead, check out this video here, and I'll catch you later.